Hello, everyone, and welcome to American Ag Credit's first Harvesting Value webinar. My name is Jacob DeBoer, part of the marketing team here at American Ag Credit. We're excited to bring this interest rate update and outlook to you today as we take a look at how the Federal Reserve sets interest rates and how that fits into the broader landscape of the ag economy. Before we get started, I'd like to remind everyone of a few housekeeping items. You are welcome to submit questions for our speaker at any time during the presentation using the Q&A feature at the bottom at the Zoom taskbar. We'll do our best to address questions at the end of the webinar, and we'll follow up with those who we might not have time to get to today. Additionally, this presentation will be recorded, and we will share the link to the webinar to all attendees after the presentation concludes. Our speaker today joins us from Terrain. Terrain's expert analysts distill vast amounts of data to deliver actionable insights for your businesses. Terrain is a complimentary offering for all customers of American Ag Credit. If you're interested in receiving notifications for new content, you can scan this nifty QR code we have on the screen here, or visit agloan.com/terrain to opt in for email notifications. Now it's my pleasure to introduce today's speaker. Matt Clark is Terrain's Senior Rural Economy Analyst, focusing on the impacts of interest rates, land values, and other macroeconomic trends in agriculture. Matt previously worked as an economist at the Federal Reserve Bank of Kansas City. As part of the Terrain team of economists, he delivers expert analysis to customers of American Ag Credit. Matt spends his free time with his family on their small hobby farm, at church and 4-H activities, fishing, hunting, and raising giant pumpkins. I want to hear more about that one day, Matt. Thank you for joining us this afternoon, and I'll go ahead and let you get started with your presentation.
All right, thank you, Jacob, and thanks everybody for signing on. I know there's a lot going on, so I appreciate you taking time to sign up. So I will bring up my presentation. We'll get going. I always think when we have events like this, sometimes it's best, we're talking interest rates and it's sensitive, it's best just to get the big question out of the way. So this slide here is just sort of a way of acknowledging the impact that interest rates have had on agriculture. So this is a question that the Purdue Center for Commercial Agriculture's producer survey, also known as the Ag Barometer, typically asks many questions, but one of them is, hey, is now a good time or a bad time to make large purchases like equipment or land? And then if it's a bad reason or a bad time to make those purchases, why? And interest rates have unsurprisingly been one of the top reasons why now has been a bad time. And it's been a growing reason here for the most part for the last several months inside their survey. So as part of this, we realized that this is an issue, and that's why we were asked, or why I was asked to do this webinar. So I titled the webinar in light of that, is the sting of higher interest rates, is it over? Are we at the end of that? Where are we inside of this? And I'm hoping I can kind of walk through the process today, understanding of where we are with interest rates, what would be the drivers for both short and long-term interest rates, and then where do I see it going? So the outline for today is fairly simple. I'm going to start by talking about the Federal Reserve, the Fed funds rate, that is sort of the short-term rates. So think about rates that are within a few months to maybe just outside of a year. So those kind of rates. We'll take a little lesson from Mary Poppins that I think sometimes gets lost even in today's modern world. Then we'll look at long-term interest rates. So think about your long-term notes on maybe bigger machinery purchases and or farmland rates. And then finally, we'll wrap it up and we'll just kind of bring it home and what are some implications for you, the farmer, as we go through some of these charts. So without that, I want to start with the chart here that I think highlights the dilemma that the Federal Reserve is in. So if you go work for the Fed, they tell you got 2 jobs with the Fed funds rate. 2 jobs, only 2 jobs. You are to maintain maximum employment, which is typically viewed as the unemployment rate, and you are to maintain stable prices, which is typically a measure of inflation or a way of looking at inflation. So what you're looking at in this chart is any time period in the gray is when the Fed has increased the Federal Reserve rates or the Fed funds rates, okay? Typically, they do that when 2 conditions are met, as I just mentioned. First, they do that when unemployment is falling or when it's significantly under like the non-cyclical rate of unemployment. So think of this as a period when employment or labor is already at maximum. and they do it when inflation is rising. So here on the blue line, you have a trim mean CPI, or just an inflation metric. You'll notice that most of the periods in which we were raising interest rates were times in which inflation was also rising above that 2% level. So if you're the Fed, you have to walk this careful balance of when do we raise rates, and you're walking it inside of these two metrics. So my goal is going to be to walk through both of these metrics and talk through why I believe the Federal Reserve may begin to lower interest rates a little bit this year. So let's start with the first one, and I think it's probably the most obvious to me, and that's the unemployment rate, or maximum employment, as the Fed would say. The chart you're looking at here is charting the unemployment rate in a couple different ways. That green line, it's called the headline unemployment. That's the unemployment rate that you hear on the news that typically comes out and they say, hey, unemployment rate is currently 3.7%. The gray band is the other 6 measures, or the other 5 measures, if you will, that the Bureau of Labor Statistics calculates for unemployment. Whether you're looking at the green line or whether you're looking at kind of that gray band, most measures of unemployment are low, and they're low compared to most of our historical times. If you think about that green line compared to the red line, which is a non-cyclical rate of unemployment, we're significantly below that. On top of that, if you just think about my preferred metric, which is taking the total jobs that are available, the total jobs being worked, and dividing it by the working age population, you get the blue line, which is generally a good indicator for how much unemployment is out there. You'll notice that the green line here, headline unemployment, is below both the blue line and the red line. To me, what that indicates is, hey, even if we see unemployment go up a little bit, so next unemployment report comes out and the Bureau of Labor Statistics says, hey, unemployment rate is now 3.9 or 4%. From the Fed standpoint of view, I still think they would view that as, hey, we're already at maximum employment. We're already there. And so there's some wiggle room for the Fed on this metric. It could bounce around a little bit, and I don't think it would have a large impact on the Fed's decision of hiking or cutting rates going forward. And I know for many of us, we read the headlines and we see these big layoff numbers, and those are all real. I mean, I don't want to discount those at all. We've seen quite a few, particularly in the tech sector, the layoffs. What I would encourage everyone to do is to not get too distracted about the layoff numbers, because they're big. Totally get it. But if you look at the numbers that really speak to the total employment rates or total labor utilization, it's really quite impressive. So here I picked out 4 that I follow. You'll notice and I'm comparing them to the first week of 2020. So kind of pre-COVID, right before COVID happens, where are we today? Well, today we've got about 9.5% less unemployment claims, or people who are filing initial unemployment claims. We got about 1% less continued unemployment claims. So those who have already filed initial and are still on unemployment, right? On the flip side, we have 1.8% more working age persons. So despite less unemployment claims, we actually have more people in the labor force. And our labor force participation obviously was hit really hard in COVID, but has really rebounded quite nicely. And it's come to be pretty close to where we were January 2020. That is to say, I know that all the layoff headlines, they can kind of be nerve-wracking, and those are real persons that are really being laid off, and it's sometimes hard to reconcile those with that 3.7% unemployment rate. But most of the data is indicating that those individuals are getting jobs fairly quickly. The unemployment rate is fairly stable, and labor is very close to, if not already at, or well past maximum employment. So from the Fed standpoint of view, I would view that part of their mandate mission accomplished. The downside to that, if there is one, is maximum employment, or when we're at that, typically leads to wage inflation. There's a lot of different ways to think about wage inflation, and for the general economy, generally that's an okay thing, but it can spill over into general inflation. And in some ways, we've seen that. So the chart on your right is just a handful of different measures. There's no one way to measure wage prices or wage inflation. So Here I have a measure from the Atlanta Fed. I have the CPI's wage number, and I have a median weekly earnings, which would also take into account how many hours everybody is working during the week. All of those numbers are above that dotted line there, or the solid line there, which is sort of your long-term historical average. That is to say that for the most part, we have had low unemployment. We are at maximum employment in many measures. As a result of that, we've had quite a bit of wage inflation, and that's fed into a little bit of our general inflation outlook. And if we're honest, the macro side of it and the labor side of it looks pretty clear. The inflation part, though, is still the piece that the Fed's fighting, and it's going to drive the bus going forward. This chart is a simple way of kind of showing some historical relationships between the change in federal funds and the change in CPI or inflation during a rate hike cycle. So all the dots here represent the change in the federal funds when the Fed started raising rates, and then what impact did that have on inflation? Generally, as the Fed raises interest rates, it takes a while for inflation to start bending. Those blue dots there is kind of the path that we've been on recently. So this is 2022 through present. You'll notice some obvious things. So those blue dots, they're way above the rest of the dots. What does that mean? Well, it means that inflation was very high before the Fed started to raise interest rates. Kind of goes back to the dilemma the Fed was in. You know, inflation was transitory as transitory. When it became evident that it was not, they were kind of a bit behind the eight ball. They had to raise interest rates very fast. So you can see how far they had to raise interest rates in the timeline there of those blue dots. You know, what you'll notice finally, and I've got that arrow there, that the last data point there is where we are today. Generally speaking, if you look at our current inflation metrics and our current Fed funds rate, we're roughly at the relationship that you would expect the Fed to stay at, which is a good sign. That means, from my point of view, it's highly unlikely that the Fed would raise interest rates. We're already at maximum labor utilization. It looks like we've at least stalled out the increases in inflation, so it's very unlikely that the Fed would raise interest rates. The real question is, are we at the point to where the Fed would lower interest rates in 2024? And a lot of it's going to depend on this question that I put on up here, and that's, is inflation dead? So I listened to Jay Powell's last speech. I just grabbed a handful of these metrics that he's used. So there's really no need to go through them. These are just different CPI measures that he talked about that he's watching. And he's looking for those to moderate back to 2% in his own words. That does not mean that it has to get all the way to 2% for the Fed to lower interest rates, but they need to see some progress back to it. Shelter, that green line, or rent has been in the news a lot. It's been probably the stickiest of all of these inflation metrics. It's come down some, but still, it's been a very slow movement. If you're the Federal Reserve, there's a bit of a historical part here too. If I were to take this chart back into the 70s, you would see a period in which inflation increased rapidly. The Federal Reserve increased federal funds rate and thought they had inflation beat, but in doing so, they lowered rates quite significantly, and then we had a period of reacceleration of inflation. That led to some of the terrible highs in the 1980s that we had to deal with, and here at Farm Sector, we know that more than anywhere, where individuals are paying 18, 19, 20% plus on their operating notes in farm country. We did beat inflation with interest rates during that period of time, but we did so at a great cost. And I think the Fed is going to be very, very careful this go around to make sure that inflation is dead before they start cutting interest rates, particularly quickly. And I say that too because the risk to general reinflation is still present. Most people are employed. Wage inflation is part of where we are. The economy is still growing. There is risk there of a re-acceleration of inflation if the Fed were to cut too quickly or too soon. So what I'm encouraging everybody to do is to pay attention to the nuances of inflation reports. So typically what we get is a year-over-year inflation calculation, which in this bar chart I've calculated here on the left. So here you have the January CPI numbers, you have the December PCE numbers. On Thursday, we will get a new PCA report. So tomorrow we will get a new inflation reading. If you've got some sort of interest rate pricing coming up, some sort of loan coming up, that Thursday report will be very important to listen to. Should inflation come in weaker or closer to the Fed's 2% goal, you're likely to hear talk about the Fed cutting sooner. If inflation were to reaccelerate, you will probably hear the Fed about holding higher for longer, even in 2024. So pay attention to that Thursday report. Additionally, pay attention to the nuances. So like I said, normally we get the year-over-year report. You can also kind of divide this data differently. So in this table or this chart, I have those same reports figured over the last 6 month annualized, last 3 month, and then the last month annualized. Depending on the measure you use and depending on if you're looking at a year-over-year or 3 month or monthly annualized, your view of inflation can be quite different. And so as the Fed tries to balance this, they're in a bit of a dilemma. So in my personal view, they are going to want to see several months or at least steady progress back to that 2%, likely from a number of different ways. In other words, they won't want to see a quick reacceleration in monthly data. They'll want to see the year-over-year moderating as well as some of the annualized data. So let's pause for a quick moment and talk about what that means for rates. I've given you a kind of a background here where, hey, we're probably at maximum employment. Inflation has moderated quite a bit. It's not quite back to the Fed's 2% level yet, but it does appear it is moderating. So from the Fed standpoint of view, they still have a handful of meetings here in 2024. Those are going to be the metrics that they're going to look at to determine if they lower interest rates. In December, they already said they're on the path. You've heard various Fed officials over the last several months mention, yes, it's possible we still lower rates. It's also possible we don't. Now, be careful, watch where this goes and watch where this evolves. So here's the table, the way I like to think about the evolving nature of how the Fed is looking at it. So the kind of gray band you see here is the range of Fed economists' forecasts in December of where they thought the Fed funds would be. You'll notice that someone on the Fed board does not think we'll cut rates all the way through till March 2025. Others think the likely range is going to be far lower, closer to that 40-year average of the federal funds rate. Okay. The median is roughly 3 25 basis point cuts in 2024. Okay. Now, when the Fed initially said this, or initially came out with this information, the market really took it as, gosh, the Fed is going to cut a lot. So if you look at that blue line there, that's what the CME Fed Funds Futures market looked like January 12th of 2024, which was estimating numerous cuts in 2024. Okay. Over time, the market has started to realize and come back towards or closer to the Federal Reserve standpoint here, with that red line matching closer to the green line. That is to say, the market also now expects the Fed to cut roughly 3, maybe 4 times in 2024. Kind of depends on the day. So here I grabbed it February 23rd. Today it could be slightly different. But typically that's where the market is looking at it, that kind of 3 to 4 cuts in 2024. What I'm telling individuals and how I'm personally thinking about things is, let's be careful on this to not bank too heavily on these cuts. It looks likely that the Fed will begin to cut. Maybe it's May, maybe it's June. They'll start the process of cutting the federal funds rate. They'll probably cut those rates slowly, which will have a direct impact on some of your variable rate notes or some of your short-term notes. But I'm not getting too far in front of that, and I'm trying to be cautious with it. I'm trying to stress test, hey, what happens if they do cut this amount? What happens if they don't? What does that look like? I'm thinking through that part very carefully for myself. What's important too to remember that despite the Fed cutting interest rates, we all learned what in Mary Poppins, when little Michael goes to Dawes, Tums, Mosley, Grubbs, Fidelity Fiduciary Bank, they tell him to do what with his tuppence? Well, they tell him to invest it because he gets interest out of it. Well, over this period of time, we've also learned that that principle is still true. So Mary Poppins was right? A good childhood lesson. As interest rates have gone up, money market accounts have taken off, CD rates have gone up, deposit rates have increased. Banks have been significantly increasing those deposit rates to try to bring back deposits maybe out of money market funds or out of other funds. The important part to keep out of this is while banks are doing this, even if the Fed cuts rates some, you will see a reaction in these retail money market funds. You will see a reaction on deposit rates. You will see a reaction on CDs, but it won't be as instantaneous as the Fed cutting because there is still a fight for those deposits. Just like they told Michael, if you invest that tuppence over time, it's going to earn interest. The same principle. The banks have those CD rates, some of them already locked in for 1 year or longer. Some of those will be slower to adjust. So those short-term interest rates, even if the Fed cuts, will still be slower to adjust a little bit than the Federal Reserve. With that, let's turn over and think about long-term interest rates. So these would be interest rates more for your machinery purchases or specifically your land purchases. So the Federal Reserve will move the short-term interest rate. That will have an impact on long-term interest rates. Other things that will matter on this are things like consumer health or business profits or the general economic outlook has a very large outsized impact on long-term interest rates. And if we think about economic sentiment, it's sort of an interesting way to think or way to ask how good is the economy doing. These are very unofficial notes or very unofficial measures that I like to follow that kind of give me an idea of how do people feel about the economy. So the blue line there is a really simple way. I just asked Google, how many times has the word recession been typed into your search? And I said, okay, the times it's been typed in the most, let's make that 100. So you'll notice here in roughly the beginning of 2022, recession was typed in more times into Google search than it was during the Great Recession, kind of in 08, 09, which I thought was fairly interesting. Likewise, the red line is it's a survey that's asking banks, hey, how are you adjusting for poor economic performance? Do you see the economy being a reason that you're tightening loan conditions? And steadily, banks are reporting, hey, we're not viewing that as a reason to tighten loan conditions as much as we were just a handful of months ago. That's the red line. If you ask consumers, consumer sentiment has improved quite a bit, but if you ask consumers, hey, your finances better today or worse today, still a very large percentage of consumers are saying, hey, our finances today are worse than they were. Now, that has not stopped consumer spending, as we'll see, but from a sentiment standpoint, a lot of that is built in. And some of that consumer sentiment is due, in my opinion, to the high interest rates that they're paying, whether that's on cars or credit cards or whatever that would be. So the sentiment seems to be better in some ways, but is also going a little bit opposite in others. Let's talk through that a little bit. If we were to go to Starlink and sit on Elon Musk's Starlink and look down and say, okay, well, how's the global economy doing? How are we doing? It's a bit of a mixed bag. You have some economies that did very well in 2023 and are expected to do well in 2024. So that would, over there on the left, you've got Japan, Russia, Brazil, Mexico. Now, importantly, this is work from the IMF that came out here at the end of 2023. Japan has since said, hey, 2024 looks like it could be a recession. So take that one with a grain of salt. But still, they've had a good run recently. You've got others like the US and Canada, which the US specifically had a great 2023. If you think about the last 6 months of 2023, US was growing roughly around 4% annualized GDP, which is just super hot for an economy our size, roughly a quarter of total global GDP. That was super hot. If you think about our 2024 outlook, it's decent. Okay, it will probably not be as good as 2023, but still within the normal range that we've seen. Then you have other countries like South Korea, the European Union or Euro area, China, UK that you've heard in the news are growing slower. So it is a bit of a mixed bag, and that's had some very different effects, particularly in the agricultural world, as we think about where money is flowing. It has flowed a lot to the dollar. It's made your exchange rates more. It's also put some pressure on treasuries or your long-term interest rates. As the US has kind of run past many of these countries, it's put pressure on our own interest rate scenario. It has not necessarily slowed the consumer one bit. This is a way of looking at consumer spending here, where we're looking at debit, credit card purchases here with the green line of consumer spending. We're just simply asking, okay, are we spending more or less than we were January 2020? Obviously, during COVID, that number dropped sharply lower. But as you can see over the time, we've just absolutely spent the socks off of most of our retail spending's been absolutely excellent. The consumer has largely spent well. Some of that, not all of that, is due to credit cards. Okay, credit card balances are higher. They're not maybe as detrimental as maybe you might read in some news reports. If you look at credit scores, are still decent. If you look at real disposable income, which we'll talk about perhaps later, also in a decent spot, which is to say that consumers do have money to spend. They have been spending it. As wage inflation has risen, as general inflation has moderated some, consumers have generally benefited from that. They've spent heavily, which has allowed 2023 to be a very strong year. It's allowed 2024 to start off on a good pace so far. Looks as like it'll keep. That will keep some pressure on those long-term interest rates going forward. There are decent reasons too to believe that the consumer will continue to be strong in 2024, leading to a generally a good or okay economy. Some of that is the idea of assets and income. That's the chart on your left. You know, if you think about assets like home prices or the S&P 500, you know, again, comparing those to January 2020, they've really taken off. They've run very, very, very fast. Real disposable income, or the amount that individuals actually have to spend at the end of the month, the amount of income that they have, is also increased quite sharply, and it's maintained. It looked like in early parts of 2022, most of 22, it looked like that may be a struggle, but it's actually really accelerated, and it's accelerated into 2024. Likewise, credit scores actually have improved quite a bit since January 2020. All these metrics, you know, there's caveats to them. Are there higher delinquency rates in credit cards? Sure. Are there some auto loan issues out there? Yes, there are. Are there some issues with commercial real estate? Yeah, some of that's out there. But generally, most of the data would indicate that consumers are doing well, and that the economy running into 2024 looks pretty good. The important part of that is generally as the economy improves or as economic performance improves, generally long-term interest rates or long-term treasuries generally move higher. And so because of that, there's some expectation that we will see higher, maybe not a whole lot higher, but at least some stabilization and maybe some higher interest rates as we move forward into 2024. Here's another way of expressing what I just said through a chart that looks complicated, because I want to call myself an economist, so you gotta make complicated charts every now and then. So this chart kind of helps explain that in my mind. That red line there is it's like a fully callable 10-year note. So think about this as like a prepayable 10-year farmland note. Those prepayable 10-year farmland notes increased significantly, or started to increase, as the Federal Reserve said, hey, we're going to start raising interest rates. That makes sense. Economically, you would expect as the Fed raises interest rates, that the longer end of the yield curve, those 10-year prepayable notes for like a farmland note, would increase, which they did. Additionally, the Fed stopped or slowed their rate of increase of their balance sheet, and then eventually stopped building their balance sheet in June of 2022. And again, as their balance sheet declines, or as the amount of assets that they're purchasing, when they're purchasing mortgage-backed securities, or when they're purchasing government treasuries, as they stop that in June of 2022, you would also expect long-term treasuries to increase, or long-term callable notes like a 10-year farmland note to increase, which they did. All of that worked absolutely swimmingly. Economics 101, finance 101. It was just roaring right along through 2022, made perfect sense. Then we got to 2023 and we started having oddities, right? We had the fallout of several commercial banks that got out there a little bit too far. We had that fallout. So because of that, we started seeing treasuries get really wobbly. We had all this question again of are we at the end of this? Is there some sort of recession coming? And there was serious concerns about, in the early parts of 2023, what the economy would look like. Okay. At the same time, we had this very protracted debt limit discussion, and then we had a very large increase in the purple line of our U.S. government debt. All along, kind of behind the scenes, U.S. economy actually grew really fast, and it grew really fast in the back half of 2023. So because of that, you got a really complicated scenario going on where by some measures, such as Fed securities holdings declining, growing economy, you would really expect those 10-year type treasuries or long-term financing for farmland to remain elevated or go up a little bit. At the same time, we've got some uncertainty about government debt. We've got some uncertainty about how much will the Fed cut in 2024. You can see the market reacted quite a bit when the Fed said they were going to cut rates. Treasury started to decline pretty quickly. Those have since come back up some. Some of that uncertainty has kind of led those kind of 10-year prepayable farm credit notes or long-term notes on farmland, I would say, to kind of hang in a certain spot. They've kind of flattened a little bit. They've increased here recently some. There's just a lot of uncertainty going on this. Why do I share this slide? I share this slide because, look, if you've got an opportunity to buy some land or you're looking to price some debt out 5, maybe 10 years, there's an awful lot going on. And it's a really good time to be in front of it and talking with your farm credit RM or your farm credit financial officer, whoever that is, working with them and saying, hey, I know I have an opportunity to buy some land. What products do you have that are out there? What are the current prices? What's the forecast, the next couple of weeks? What's the forecast maybe a month from now? How's it moved over the last several weeks, several months? It's a really good time to be in that market, talking with your relationship manager, with your financial officer, with your lender, making absolutely sure that you know the products that are available and that you and them have a game plan for, hey, if I have a chance to buy this land, I want the right products. I want to know what those products are, and I want to be ready to execute. Because frankly, there could be some more movements on these type of notes, and it's just important for you to know your options, know your limits, run the stress tests, and work with your bank in those scenarios. It's also important to think about the way cash will impact our farmland purchases or our farmland note discussions. So here in green, you have the average fixed farmland rate going back to 1985. And kind of that little gray band is the sort of the band or the range around those notes from various surveys that I'm using. Those dotted lines are the averages that we had in the 1990s in yellow, 2000s and purple, and then 2010s in blue. A few things stick out to me in this chart that I want to highlight. First, it's obvious that farmland interest rates have increased quite a bit, right? They're above the average that we've seen the last several decades. They're not back to the 1990s levels, but they've increased to the highs that we saw back in kind of that 05, 06 period. So that part's fairly obvious. The other thing that I want to draw out here is the red line. This is the national average rate on a 90-day CD. Okay. What you'll notice is as banks fought for those deposits, as we talked about earlier, they significantly ramped up those CD rates, which many people took advantage of, which is a blessing. However, notice that the current 90-day CD rate is above the average farm loan book from 2010 to 2019. That starts to shift the way in which your mind works on the value of cash, the relationship that cash will have on your next purchase. How much down are you going to put on your next farmland note? This starts to change it. If you think about just the gap there between the red line and the green line, it's very different, or it's much closer than it has been over the last several decades. As a result, here again is just a point that when you go work with your farm credit banker, it's important to discuss what your cash options are, how much you can put down, how that will change the note term, how that will change the interest rate, what are your options inside of those product mixes, because that cash is worth quite a bit, and it's going to make an impact on your next decision for your farmland, and it's going to make an impact on the products that you choose. It's going to make an impact on potentially rates. It's just a very good time to be in close communication. If I were to forecast this out a little bit further, I do think the Federal Reserve cuts a little bit. So again, like I said, 3 cuts seem very likely. The impact on farmland rates, I think, will be slightly more muted. So I don't think you'll get a straight tit for tat on farmland rates. So every 70 or every 25 basis points down, I don't think we'll make an exact tit for tat 25 down on farmland rates. So again, it's going to be important to be in communication with your banker. Now, if we were to go back to Ag Finance 101 and I were to paint this picture to you that, hey, the economy seems decent. We saw that stock market chart. That's sort of an alternative to farmland. We've seen these these higher increased farmland mortgages, what would that mean to farmland values? Typically, we would say, well, gosh, I think, Matt, that probably means farmland values are going to decline. And look, if you do your outlook on most commodities other than beef right now, it's maybe not as rosy as the last few years. That would typically make sense. But if we look through the data, particularly in the Midwest, we do not yet see a decline in farmland. Now, you have to segregate out of here some water issues. So, if you're in California and there's, some water discussion around SGMA, or maybe you're in an area that's losing a lot of orchards, that's a slightly different discussion. If you're in an area where Midwest, where you're thinking cash grains, you're thinking cattle, so far we have not seen a significant decline in farmland values, which is a good thing in some senses. If you look at this chart here, I've taken the 2009 to 2015 run in farmland values, and those are the solid lines. And I'm comparing them to the run that we had in 2019 to 23 in the dotted lines. You'll notice very similar shape, very similar movements, okay? There's differences in drivers. If you think about 09 to 2015, interest rates were low. You had kind of the ethanol boom. You had China purchasing an awful lot of product. You also had generally high commodity prices. We were on a really good run even in the permanent crop side, if you think about that. That's different than the scenario we're in today. But we don't yet see that decline in farmland values en masse. The important part I'm taking from this is because of the increase in farmland values, if you think about your interest cost per acre on a new farmland note, it can be, depending on your product, as high as it was in 1980s. So that's not due to interest rates, but it's mainly due to the increase in farmland values. So again, having that opportunity to step back, work with your banker, say, okay, I think I'm going to have these deals. I realize that land values are high. What can you do? What's the products? What's out there? What's the process with appraisal? What's the process with the lending side is going to be pretty important because frankly, these values are quite elevated. And on notes today, it's worth your time to spend that opportunity to do the analysis with your banker. So let me bring this home, and then Jacob will turn it over to you for some Q&A. So some things that I'm thinking about, and the way I'm looking at things, like let's stress test our interest rate exposure very carefully. So both your short rate notes, maybe they're variable. What would it look like if the Fed didn't cut rates for the rest of the year? What would it look like if the Fed cut rates maybe 3, maybe 4 times? What would that do to your interest rate exposure? How would that change your operation? Secondly, and I think it's worth spending quite a bit of time as you work through it, just asking, would declines in interest rates or interest rates being cut, do I need that to be profitable? Or do I need to really focus in on some other areas? Maybe it's my marketing area, maybe it's other pieces. And how can I then go to my lender and say, okay, these are the areas that I need some help in. These are areas that I don't. Third, probably one that I'm thinking about a lot more is really thinking through if you are a grain farmer and you have some of those grains that are still in storage, or you've got some prepaid inputs you're considering putting on your line of credit, make sure you're calculating that cost of interest all the way through and kind of really coming out with what is that cost to carry, whether it's the cost to carry grain, whether it's the cost to carry prepaid inputs, what is that true cost to carry? Because as interest rates have increased, that cost to carry on the interest side has increased. If they are to remain elevated, it will also remain probably a sticky point. It may change your decision a little bit on how much you're carrying or how much you're storing when you're looking to exit some of those options. Fourth, this is probably a big one. If you're thinking through land purchases, it's very, very, very important to sit down and think, okay, how much cash am I going to need? Land values have gone up. The cost of money has gone up, or to say it another way, the interest I'm getting paid to hold money at the bank has gone up. How much am I going to need to fully execute on those loans? What am I going to need to put down? What will that do to my interest rate? What does that do to my options that I have with the banker? Are there new options of loans that are out there that I haven't considered before? So again, if you've got those purchases coming up, it's a really, really good time to be in front of it. It's always easier if you're in front of it than behind it from the banking sites. side of it. And finally, I would just very carefully evaluate those return on asset or return on investments, your internal rate of return on your investments very carefully. That hurdle rate has moved quite a bit. If you think about 2010 to 19, when cash was worth very, very little, was not worth much. The hurdle rate on that next purchase was also not much, right? Because the interest rate or the cost of borrowing was also not much. Now that hurdle rate has moved, cash is worth more. The cost of buying that next asset or the cost of increasing line of credit has changed. You need to think very carefully about what those returns on investment will be and just think about it differently, because leverage looks different today than it did simply 4 or 5 years ago, even. Quite a bit of different scenario. And even for myself, I find myself back in that kind of 2010-19 period where I haven't readjusted my mind to, hey, the hurdle rate is higher because my cash is worth more, and I need to think about this investment slightly more carefully or in a different way to make sure that my return on investment is applicable. Okay, I talked for almost 35 minutes, so it's important that I don't talk any more than that, or it will start to get boring. We need to hear from you. So, Jacob, why don't I turn over to you? We'll see what's in the chat, what's in the Q&A, and I'll stay here as long as we need. Chat through it.
It was 35 minutes of great content. So thanks for walking us through that, Matt. I really appreciate your ability to pull out tangible things that we can put our hands around from your complicated economist charts. So I appreciate that. Also think it's super important to, as you say, keep that dialogue with your lender front of mind as you look at liquidity, cash flow, or even as you plan your operation expansion or you have your eye on a piece. I think that's something super important to keep in mind. Like Matt said, we now have time to answer a few questions. I'll remind everyone that you could submit those to the Q&A function in the Zoom toolbar. Also would like to welcome Rich Gleason to join us for this Q&A session as well. Rich is the Director of Regional Banking for our Kansas lending area. So welcome, Rich.
Thank you, Jacob.
Matt, we do have one question that has come in, and I'm going to probably point that at you. The question is around, do you have a favorite indicator? So does the dot plot or the CME trend tend to be a better predictor of rate changes?
Oh, what a great question. Okay. Markets tend to move quicker than the Fed. So let me start with that. So if you were to go out to the CME Fed Funds Future, or if you just go to your Google bar and type in Fed Watch Tool, CME Fed Watch Tool, you'll be able to pull up some of that data that I showed you. It's free out there. It's a great tool to use. Okay, it gives you the idea of where rates could go. The CME Fed Watch Tool, or the Fed Funds Futures, tends to be more volatile than the Fed. It moves up much quicker, moves down much quicker than the Fed does. I hesitate to say that it's better or worse because that forward curve, if you will, from the Fed Funds Futures does matter in the pricing of some of your loans. So if you were thinking about something more complicated like a swap, that forward curve pricing is going to be much more weighted towards what that CME futures is going to do. So from those standpoints, it does matter. When I am personally thinking about my views on rates, I tend to weight more heavily towards to the Fed. Okay. Now, saying this carefully, they got behind the curve in 21, 22. And so for a while, it would tell you that maybe the Fed dot plot wasn't as accurate. But for the most part, over the last, I would say, year and a half, those dot plots have been pretty accurate predictors of where the Fed is going. And so I follow those very carefully. I really do. I think those are, especially at a time now where we're at an elevated level, I think those are very good indicators for where the Fed could go. If you want to find those dot plots, if you Google search it, I don't know the website off the top, but if you Google search FOMC calendar, you'll get a calendar and there'll be a link there for presentation materials at each meeting, and you can go download those dot plots. So typically I put more weight on the dot plot, but just to be clear, I'm also daily looking at the CME futures just to see what the market's thinking on that side. But that's a long answer to that short question. Good question.
I think it's a thoughtful response and helpful resources as well. Thanks, Matt. That is all the questions that we're seeing right now. But if you have any that you'd like to go ahead and put in, we still have a couple moments. But I'll remind that if you have any questions about this topic or anything else, you are always welcome to reach out to your current relationship manager at American Ag Credit, or give us a call and we'd be happy to set you up with someone who you can have this individual dialogue with. You're also welcome to reach out to Matt directly. He shared his contact information in this presentation. Or you can visit our website at agloan.com, where you're welcome to sign up for terrain updates as well. I'm not seeing any more questions come in. So I think with that, we're going to say thank you for joining. Have a great rest of your day, and we'll be sharing a recording of this presentation with everyone who joined us. So thanks for joining.